Imagine spending your entire life, just building an empire.
Right, like putting in decades of work.
Exactly. You build this massive fortune, you're working tirelessly to secure your family's future, only to know with, well, near mathematical certainty that your grandchildren are going to lose every single penny of it.
It's pretty grim. It sounds like some sort of Greek tragedy.
It really does. But, I mean, looking at the statistics, it is the mathematical reality for the vast majority of wealthy families.
Yeah, the numbers are wild.
90% of high-earning families lose their fortune by the third generation. Just, 90%. Gone.
It's a staggering failure rate when you really think about it.
It is. So today, we're going into this deep dive, exploring a single, highly detailed masterclass script. It's titled The Rockefeller Blueprint for Generational Wealth, and it's produced by lifeinsurance.com.
Right, and the mission here, for you listening, is to unpack the actual mechanics of what they call this 100-year financial fortress.
Yeah, we want to understand exactly why that 90% failure rate happens in the first place, and then, break down the specific financial architecture that families like the Rockefellers use to build a self-sustaining legacy.
From infinite banking to these really obscure IRS tax codes, we are essentially reverse engineering how ultra-wealthy families construct these financial ecosystems that last for over a century.
Exactly, because we are dismantling what the source calls the wealth illusion. And we're going to look at the nuts and bolts of how this structure actually operates.
Yeah, because most of what the public is taught about, building wealth, is actually just a recipe for generating high income.
Right.
And those are two completely different mechanisms.
Okay, let's unpack this. Because this distinction, it shatters a lot of conventional financial wisdom right out of the gate.
It really does.
The documentation starts by pointing out that most high earners completely confuse income with wealth. There is a very specific example in the blueprint. They talk about a medical or legal practice generating like $1.2 million a year.
Which is obviously a massive income.
Yeah, most people hear that top-line revenue and assume, wow, incredible wealth. But if that same professional has a $40,000 a month burn rate...
Right, between the jumbo mortgage, the luxury car...
Placed private schools, general lifestyle inflation, all of that, they aren't actually wealthy. They are just highly leveraged.
We die.
They are running on a very expensive treadmill that requires this continuous high-octane fuel just to keep the lights on.
It's an operational vulnerability, basically.
Yeah.
They have built this expensive infrastructure that collapses the exact moment the income stream pauses.
Yeah.
And that leads directly into a structural flaw the blueprint calls the correlation trap.
Oh, this part was eye-opening.
Right. Think about how most successful professionals build their lives. Their high income, the value of their primary residence, and their stock portfolio are almost always tied to the exact same macroeconomic cycle.
It's like thinking you're safe on a boat because you have 3 different sails, but ignoring the giant hole in the hull.
That's a great way to put it.
If your income, your house, and your stocks all rely on the exact same economic weather, one bad storm sinks the whole ship. When the broader market drops 30%, it's never just an isolated event.
Right, it's systemic.
Exactly. Your portfolio tanks, your property value takes a hit, and your specific industry might be facing layoffs or reduced client spending all at the exact same time.
And the illusion of security just shatters all at once.
Yeah.
And that shattering really exposes the net worth fallacy. Society trains you to look at net worth as the ultimate scoreboard of financial success.
Yeah, like hitting a high score in a video game.
Exactly. But traditional net worth, it's just a fair weather metric. It looks spectacular when the sun is shining and, the markets are coasting on a 10-year bull run.
But true wealth isn't defined by what you hold at the peak of a market cycle.
No, it is defined by what survives a disaster.
Which honestly requires a completely different psychological approach. When you look at the psychology of the 1% families like the Rockefellers, they are not playing a 30-year game.
Right. They aren't trying to hit a magic number by age 65 so they can go play golf.
Right. They are playing a 100-year game. That necessitates this massive transition from a consumer mindset where the focus is entirely on the money you spend to a steward mindset.
Yeah, because a consumer just asks, what lifestyle can this capital buy me today? But a steward looks at the exact same capital and asks, how can I protect, position, and amplify this money for the next generation? Controlling capital, rather than just exchanging it for depreciating lifestyle assets, is the cornerstone of generational preservation.
Okay, so if traditional net worth on paper is an illusion, what is real? Like, how do these families actually weather the storms?
That's the big question.
Right, so the blueprint shifts into the mathematical solutions, specifically the mechanics of what they call the private family bank. And that starts with dismantling another massive financial illusion.
Oh, the average annual return.
Exactly.
This is where we run into sequence of returns risk.
Yeah.
And it catches so many aggressive investors entirely off guard.
Because the average annual return is mathematically misleading.
It really is. Let's say your stock portfolio averages an 8% return over 20 years. On a spreadsheet, that looks fantastic.
Just a nice, smooth, upward line.
Right. But the real world doesn't happen in averages. It happens in sequence. If you decide to retire and start drawing down your money to live, and in that very first year, the market drops 20%.
Oh, man, you are in massive structural trouble.
Yes.
Because you are literally cannibalizing your principal to buy groceries.
Exactly.
You are forced to sell shares at a 20% discount just to pay your mortgage. And even when the market eventually recovers, 2 or 3 years later, you don't have enough shares left in your account to capture that growth.
Right. You've permanently crippled your wealth-generating engine.
Yeah.
What's fascinating here is the mathematical reality of loss. If your portfolio loses 50% of its value, you don't need a 50% gain to get back to even.
Right. You need a 100% gain just to get back to your starting line.
Exactly.
Yeah.
So preventing massive losses is mathematically more powerful for long-term, multi-generational compounding than constantly chasing high average yields. And that is the fundamental purpose of the volatility buffer.
Okay, the volatility buffer. This is where the core technical engine is introduced in the source. They're talking about the cash value of a permanent life insurance policy, optimized specifically for this strategy.
Yeah, they call it a reserve tank.
Right, a reserve tank that comes with a 0% floor. But I want to break down the actual how here, because it sounds a bit unbelievable. How does an insurance company magically guarantee that your account won't lose money when the entire global economy is crashing?
Well, it isn't magic. It is just institutional risk pooling and very strict asset allocation.
Okay.
When you pay into a permanent life insurance policy, the insurance company doesn't take that money and throw it into high-risk tech stocks. They pool billions of dollars and invest primarily in highly conservative, long-term bonds and commercial mortgages. Then they use a tiny, tiny fraction of the yield from those bonds to purchase options that capture a portion of the stock market's upside.
Ah.
Because their underlying bond portfolio is so stable, they can actually guarantee that your principal won't decline due to market volatility. You are essentially trading away the extreme market peaks. Like, you won't get a 30% return in a massive boom year to completely eliminate the devastating valleys.
So when the S&P 500 is bleeding red, your policy stays green, or at the very least flat.
Exactly.
And connecting this back to that sequence of returns risk we just talked about, if you retire and the market crashes, you simply stop withdrawing from your stock portfolio.
You just let those shares sit there and recover.
Right. Instead, you pivot. You pull cash from your life insurance policy's cash value to fund your life for that year. You act as your own shock absorber.
Yeah, you never have to sell your assets at the bottom of a market cycle ever again.
That's huge.
It is. But the architecture goes far beyond just using this as a defensive buffer. It moves into a really aggressive offensive strategy.
Right. The private family bank, often referred to as infinite banking.
Yes, and the core premise here challenges the entire traditional banking model. Like, why pay interest to a third-party retail bank to finance your life when you can build a system to finance yourself?
Right, but this requires highly specific mechanics. You don't just call a broker and buy a standard off-the-shelf whole life insurance policy.
No, not at all.
You strategically overfund a permanent policy. You pump as much cash into it as the IRS legally allows, building up this massive, highly liquid cash value.
Right.
Then when you need capital, say you want to buy a real estate property or purchase heavy equipment for your business, you don't actually withdraw your money.
No, you take a collateralized loan against your cash value directly from the insurance company.
You are pledging your cash value as collateral, much like you would, pledge a house for a mortgage.
Yeah.
But the capital you actually receive is the insurance company's money.
Exactly.
And here's where it gets really interesting. Because you borrowed against the policy rather than withdrawing from it, your actual money never left the account.
Right. It's still there.
It's essentially like having your cake, eating it too, and somehow the cake keeps growing in the oven. I mean, think of it like taking out a home equity loan on a house that is contractually guaranteed to appreciate in value every single year, regardless of the real estate market.
And you have absolutely zero risk of foreclosure if the economy tanks.
Yeah. You are spending the insurance company's money to buy your business equipment, while your original capital just sits in the policy, compounding entirely untouched.
And then, as your business generates revenue, you pay the loan back to your policy, recapturing the principal and the interest that you would have otherwise just handed over to a retail bank.
It is a total masterclass in capital efficiency. Your money is basically executing two jobs simultaneously.
Right.
It acts as the collateral for your offensive business or lifestyle investments, while it continues to grow in a tax-advantaged protected environment with that 0% floor.
Yeah, it's incredibly powerful.
Okay, so you have this self-financing engine humming along beautifully while you are alive.
Right.
But what happens when you die? Doesn't the IRS just step in, assess a massive estate tax, and dismantle the whole thing before your kids ever see a dime? Like, how does this actually survive the 100-year test?
Well, that is the ultimate stress test for any wealth strategy, right? A strong financial engine during your lifetime is completely useless for a legacy if it gets decimated by taxes or tied up in a 2-year probate court battle upon your passing.
Oh, absolutely.
This is where we look at the specific tax architecture in the blueprint, primarily IRS Code 7702.
Right. The blueprint calls this the tax-free engine. And the fundamental rule making this entire ecosystem function is that loans are not considered income.
Exactly.
But why is that? Why doesn't the IRS tax that money you're pulling out to buy real estate?
Because a loan is fundamentally a debt. It is an obligation to repay. The IRS cannot tax you on money you borrow because you haven't realized a gain. You've taken on a liability. So when you take a collateralized loan against your life insurance policy, you receive completely tax-free liquidity.
They also utilize a tax principle called FIFO accounting, right? First in, first out.
Yeah, so if you decide you don't want to take a loan and you simply want to withdraw cash directly from the policy, the IRS treats the first dollars coming out as return of the premiums you originally paid in.
Okay.
You can withdraw up to your basis, which is the exact dollar amount you've contributed out of pocket over the years, completely free of taxes. The tax liability only kicks in if you start withdrawing the actual gains.
But the blueprint explicitly points out that the real power isn't in withdrawing anyway. It's in what they call the ultimate swap.
Yes.
You borrow against the policy's growth to fund your retirement or your investments, avoiding income tax indefinitely. You just keep taking loans, enjoying the liquidity, knowing that eventually, well, you are going to die.
As we all do.
Right. And when you do, the tax-free death benefit of the life insurance policy automatically pays off all those outstanding internal loans. And whatever is left goes to your heirs completely tax-free.
The ledger is just wiped clean. You utilize tax-free loans during your life, and you clear the debt with a tax-free death benefit.
So what does this all mean? I mean, I have to ask the question any skeptical listener is thinking right now.
Sure.
Wait, so the IRS just never gets a crack at the growth? You use the money tax-free while you're alive, and the death benefit wipes the slate clean when you die. It sounds exactly like a loophole that Congress is going to close tomorrow.
I know. It undeniably sounds like a loophole when you first hear it. But looking at the history of the U.S. tax code, this isn't a gray area at all.
Really?
Yeah. Life insurance death benefits have been protected from income tax for over a century. Intentionally, for public policy reasons.
Yeah.
The government wants families to have a private safety net so they don't become wards of the state upon the sudden death of a breadwinner. Ultra-wealthy families simply engineer this existing mathematical reality to their extreme advantage.
Wow. Let's map out how this actually transfers across generations then. The blueprint details the Rockefeller Waterfall. It's a 3-step mechanism.
Right.
Step 1, the policy is not owned by you personally. It is held inside an ILIT, an irrevocable life insurance trust. Why does it have to be in a trust?
Because if you own a massive life insurance policy personally, the death benefit is added to your total estate when you die.
Oh, and that triggers estate taxes.
Exactly. If your total estate exceeds the federal estate tax exemption limit, the IRS takes a massive percentage of it, often around 40%. By placing the policy inside an irrevocable trust, you completely remove those assets from your taxable estate. You don't own it. The trust owns it.
Which protects it from estate taxes entirely. Okay, so step 2 of the waterfall is the bank. The family members borrow from this trust for approved capital needs, like, funding higher education or starting a business.
Yeah.
And step 3 is the refresh. When the patriarch or matriarch dies, that massive tax-free death benefit pours into the trust, pays off any outstanding loans the family took, and crucially, provides the exact liquidity needed to fund new life insurance policies on the lives of the next generation.
It creates a fully self-sustaining, multi-generational waterfall of capital.
It's wild.
If we connect this to the bigger picture, the contrast with how the average person is taught to plan for retirement is just striking.
Oh, completely.
Most professionals are conditioned to max out a 401k or a traditional IRA. Those are tax-deferred environments.
Yep.
You get a small tax break today, but you're effectively entering into a partnership with the government on all your future growth. You carry the market risk for 30 years, and then you pay taxes on the harvest when you withdraw it, at whatever the future tax rate happens to be.
Which could be much higher.
Exactly.
Yeah.
But the architecture mapped out under IRC 7702 is strictly tax-free. You pay taxes on the seed, the initial premium, but the harvest, the decades of growth, and the final legacy benefit is completely shielded.
There is a detailed case study in the masterclass to kind of ground this in reality. They call it the $5 million exit.
Oh, that's a great example.
Yeah, so a business owner sells their company for $5 million. The conventional advice would be to throw that liquidity into a taxable brokerage account, buy index funds, and just hope the market cooperates for the next 30 years.
Which leaves all $5 million entirely exposed to the sequence of returns, risk, and market volatility we dissected earlier.
Right. But in the Blueprints case study, the owner takes a radically different path. They take $1 million of that exit and use it to aggressively fund an optimized whole life policy over a few years. Then they immediately use that cash value borrowing against the policy to finance a new cash flowing real estate venture.
Look at the multidimensional outcome of that single allocation, though. By moving the capital through the insurance contract first, they instantly generated a $5 million death benefit, providing immediate tax-free protection for their heirs.
Right.
Second, they have a growing, mathematically protected cash reserve inside the policy that offers guaranteed liquidity.
Yeah.
And third, because they utilized the collateralized loan to purchase real estate, they acquired a brand new asset generating passive income. The exact same dollars are working in multiple dimensions simultaneously.
It is an incredibly sophisticated design, but I'm listening to this thinking, does this apply to me if I haven't just sold a business for $5 million? Is this strictly a billionaire's game?
Well, the principles of capital control, avoiding market losses, and minimizing taxes, those apply to everyone.
Sure.
However, executing the specific private family bank architecture requires significant initial liquidity to fund the policies effectively. It also comes with high setup costs, legal fees for drafting those irrevocable trusts, and ongoing management overhead. It is a highly specialized financial tool, not just a casual savings account.
Okay, I have to push back here because this all sounds too perfectly engineered. If this is just a math equation, what stops a wealthy individual from just stuffing $10 million into a policy in a single day and essentially using life insurance as a giant, unregulated, tax-free hedge fund?
Well, the IRS...
Won't the IRS notice that?
The IRS absolutely noticed that, which is exactly why you cannot just dump unlimited cash into a policy. The government sets strict statutory limits on the ratio of cash value to the death benefit.
Okay.
It's known as the corridor test. If you push too much premium into the policy too quickly, the IRS reclassifies the entire contract as a MEC, a modified endowment contract.
And what happens if you cross that line and trigger a MEC?
The tax advantages vanish instantly. Yeah, loses its life insurance tax privileges and is treated like a standard taxable investment. Any loans or withdrawals become fully taxable, and you get hit with early withdrawal penalties.
Yikes.
It requires highly precise actuarial engineering to maximize the cash growth without crossing that MEC threshold.
So this isn't just set it and forget it. If you overstuff the policy, it blows up into an MEC.
Exactly.
And there is another massive structural risk outlined here: lapses. Let's say you build this system, you take out massive internal loans against your policy to fund your real estate empire, and then you hit a rough patch.
Right.
You stop paying your premiums and you ignore the interest on the internal loans. If that policy runs out of cash value to support itself, it lapses. And if a policy lapses while you have outstanding loans...
The tax bomb goes off.
Yeah. Every dollar of tax-free money you borrowed suddenly becomes phantom income in the eyes of the IRS,
Uh-huh.
and you owe taxes on money you already spent.
It is a high-performance engine, but if you don't know how to drive it, or if you neglect the maintenance, you will absolutely crash into a wall. That is precisely why the masterclass stresses the absolute necessity of professional engineering. They specifically recommend a legacy audit from specialized firms to ensure the structure remains compliant and resilient over decades. This is the farthest thing from DIY financial planning.
Yeah, you can build the most robust, tax-optimized fortress in the world, but if the people living inside it leave the gates open or burn it down from the inside, it still falls.
Exactly.
The final section of the blueprint pivots hard from financial mechanics to human behavior. They state very clearly, money without values is a curse.
A perfect trust structure is totally useless if the heirs just squander the capital.
Right.
The blueprint solves this human element through a family constitution and incentive-based distributions.
Yeah, the trust doesn't operate like an ATM handing out blank checks to trust fund kids on their 21st birthday.
Not at all.
Yeah.
The distributions are strictly tied to behavior.
Right. For instance, the trust might be drafted to match a family member's earned income dollar for dollar.
Yeah, so if an heir earns $60,000 working as a teacher or an engineer, the trust distributes an additional $60,000 to them.
But if they choose to just sit on the couch and produce nothing, the trust distributes nothing.
Exactly. It engineers a framework of stewardship rather than consumption.
It's so smart.
These trusts can be custom designed to pay for specific higher education degrees, provide seed capital for, thoroughly vetted entrepreneurial business plans, or even match philanthropic donations.
It utilizes the wealth to incentivize and reinforce the exact behaviors that sustain capital while starving the behaviors that consume it.
Exactly.
Bringing this all together, the masterclass concludes with this technical summary matrix that contrasts the traditional wealth illusion with this private family bank model.
Right, it's a great breakdown.
On market risk, traditional accounts have full exposure to economic crashes, but the family bank utilizes the 0% floor to protect principal.
And on taxes. Traditional accounts are heavily taxed or tax-deferred, meaning you owe the IRS later. But the family bank operates in a tax-free environment under IRC 7702.
On liquidity, traditional retirement accounts trap your money with early withdrawal penalties or force you to sell assets at a loss. But the family bank offers guaranteed access to capital via collateralized loans.
Right. And finally, on the transfer of wealth, traditional assets get dragged through public probate courts and get decimated by estate taxes. But the family bank transfers wealth privately and cleanly via tax-free death benefit.
It is the stark difference between hoping your wealth survives the future and mathematically engineering it to do so.
Really is.
The blueprint closes as a very sharp thought. Your name can be a footnote, or it can be a foundation. It all comes down to the architecture you choose to build today.
This raises an important question, and it's one I'd love for you to think about as we wrap up today.
Oh, yeah.
We've talked extensively about the mechanics of the money, but think about that family constitution. If you were to draft your own family constitution today, what is the single core value or achievement you would require your descendants to demonstrate before they could access a dime of your legacy?
That is a great question because building the financial engine is really only half the battle. Building the character to sustain it is the real work.
Absolutely.
Well, thank you for joining us on this deep dive. We hope it gave you some powerful, objective tools to analyze how you are structuring your own capital.
Yeah, thanks for listening.
Until next time, keep digging deeper.